Hello, my name is Peter Douglas and I'm the CEO and Managing Director of IPAF. Welcome to our webinar coinciding with the launch of our 2024 rental market reports. This is the 15th year that IPAF has produced, in conjunction with Carlisle, our award-winning powered access rental market reports. The new reports cover 2008 to 2025, with a particular focus on 2023 and focus on North America, the top 10 European rental markets, which are the UK, France, Germany, Italy, the Netherlands, Spain, Denmark, Sweden, Norway and Finland. And they also include a focus on China. IPAF members that are rental companies, manufacturers, dealer distributors and suppliers can claim a report free of charge for the third year in a row. We believe at IPAF that this is a significant member benefit. Simply order the report of your choice online at ipaf.org/reports. Fill in a few details and we will send you a digital PDF copy of the report that you require. So today you're going to hear shortly from Youdale, editor of Access International. Euan will give his invaluable and unique insights into the world market of powered access rental, looking at the different trends across all of the global regions mentioned. Then you will hear from Theo Castel, Analyst at Carlisle. He'll go through the key findings from one specific market. We're doing a bit of a deep dive into an individual country report. This year it's Italy's turn. This will hopefully give you a good understanding of information held within these country reports and how valuable they can be to you for lots of reasons, including investment decisions, benchmarking against your competitors and against the whole of the market within those particular countries and regions. Whether you represent a manufacturer, a supplier or a rental company, it will help you see the trends and forecasts with a view to helping you budget for the year ahead. So without any further ado, over to you, Euan.
Hello, and thank you to IPAF for asking me to take part in this webinar again. In my roundup last year, there was a feeling in many of the countries covered by IPAF's rental market reports that the challenges of recent years give way to a much brighter year in 2024. While this is the case in the USA, which back in June last year was already enjoying shoots of recovery, the same cannot be said, unfortunately, for Europe and China, where the pressures on the construction sector and wider economies are intense. I'm going to spend a bit of time on Europe as it has such a diverse range of markets. In Europe overall, the mood is very much one of uncertainty. There has been a rise in interest rates on top of a decline in residential and non-residential construction and the war in Ukraine, which shows no sign of ending. Although there are always exceptions to the rule, to that point, there has been a reversal of fortunes from the pre-COVID years when Northern Europe was on a high, while the most southerly countries on the continent were suffering. Today, it is those nations in the north that are experiencing tough economies, with countries to the south, Spain in particular, seeing more positive trends. Countries sitting more centrally, including the major European economies of the UK, France, and even Germany, are also seeing declines. Talking about France, the Paris 2024 Olympics is set to be staged this summer. And although it has been a major source of work, the industry, along with the wider economy, is in a downturn. A report by the Committee for European Construction Equipment, CEC, shows that French construction activity in 2023 fell to its lowest level in 3 years, indicating a steep and accelerated decline. According to construction forecasting network Euroconstruct, prospects are poor in France, as they are in the UK and Germany. German Engineering Federation VDMA confirms that residential construction is the biggest concern, with new builds forecast to drop by 15% in 2024. In the UK, CC forecasts in its 2024 annual reports that construction activity overall is set to fall by 2.1% in the year. However, it's not all bad, and reports from the rental sector are more positive. An example comes from Europe's largest rental company, Loxam. The company reported a 6.2% increase in its 2023 annual revenues, making more than 1 billion in France for the first time. It's worth pointing out, however, this falls behind the company's results in other parts of the world, including Spain and Portugal in southern Europe and nations outside Europe, the Middle East, Morocco, and Brazil, where Loxam's revenues were 14% higher than in 2022 overall. And in Germany, the BBI, the country's rental and dealer association, is more positive about the rental market too. It says there was a slight uptick in the sector during 2023, and for this year, its MEWP rental members are forecasting up to 5% growth. In the UK, rental major Speedy Hire downgraded its profit forecast from 5% to 3%, but at least that is in positive territory. Speedy said it is performing resiliently in the face of cost inflation and macroeconomic uncertainty. So we can see rental is bucking the trend in Europe somewhat compared to the overall construction and economic slump. To put this in context with southern European countries of Spain and Italy, which are covered in IPAF's rental market reports, CC's own annual report states that construction output in Spain grew by 3.5% in 2023, and Jose Antonio Nieto, CISA's new Spanish president, noted that the construction sector in Spain is expected to avoid the downturn in sales projected in most of Europe. Association Analyst expects there to be growth in the rental sector in 2024. As further evidence of how Spain is flourishing, the country has been actively growing its relationships with Latin America through a string of new projects. Italy's forecast is more mixed. Although Italian association Euan saw a slight decline of 3.1% for construction machinery sales in the country compared to the previous year, it was still 47% higher than 5 years earlier. So this shows the true growth of the southern European countries. Last year, I mentioned a trend towards specialist access equipment in both Europe and the USA. And this continues as rental companies and OEMs look to widen their options outside of the heavily cyclical general construction sector with all of its ups and downs. In Europe, spider lift producer Hinowa was sold to JLG at the beginning of last year, which helped bump up the US OEM's impressive sales for the 2023 calendar year. And earlier this year, German spider lift specialist Teupen was acquired by USA utility lift producer Alltech, with its aims to enter the European market and grow spider sales in the USA. The advantage the access equipment sector has over general construction equipment is that it can be used in a wider, more evergreen range of applications. Understandably, rental companies are seeking to take advantage of this, rather than being stuck in the up and down cycle of construction. One such opportunity is the massive expansion in data centers. For example, Google has announced a $1 billion investment in the UK to support the company's new artificial intelligence-powered technologies. Another new dynamic for the access industry in Europe is the current investigation by the European Commission into the alleged dumping of MEWPs exported from China, effectively undercutting existing suppliers in a non-competitive way. If the Commission finds against the China-produced lifts, heavy tariffs are likely to be imposed on them. In general, the Commission's investigation has been welcomed by the major manufacturers traditionally based in Europe, which say that healthy competition is important, but it should be based on a level playing field. On the other hand, those companies opposing the investigation would argue that imposing tariffs will stifle choice for rental players in the continent. And as we probably already know, the EC investigation follows the tariffs imposed on Chinese-produced MEWPs entering the USA, following the country's International Trade Commission ruling in late 2021. Something else that Europe has in common with the USA is continued rental consolidation as major generalists keep getting larger. In April, it was announced that Europe's largest specialist access rental company, Euan, had been acquired by generalist Bowles Rental, with Euan saying that an increasingly competitive and challenging market was one of the reasons that led to its sale. Generalists are getting bigger in the USA too, as we will discuss later. On the subject of the USA, the country is seeing good growth in its rental markets and wider economy, particularly compared to nations based across the Atlantic in Europe. The results are positive from the major OEMs in the country too. JLG's first quarter for this year saw sales increase by 3.7%, thanks to sales in North America. The company said that they were slightly offset by a slower market in Europe. Terex AWP, which includes Genie and Terex Utilities, reported a small drop in its fourth quarter of 2023 in sales, but was 17% up in the full year. The company said that it was headwinds in Europe being the main contributor to negative growth. The markets in North America, however, are expected to remain strong. Speaking in February at the ARA show in New Orleans, Tom Doyle, the Vice President of Program Development at the American Rental Association, said rental should benefit with tailwinds from interest rates, inflation, improving supply, a preference to rents, and government and private spending. Indeed, in May, the association updated its forecast for this year with an increased growth projection of 9.7%. United Rentals, the world's largest rental company based in the US, also upgraded its forecast for the 2024 financial year to the tune of $300 million. Herc, another major USA-based rental company, saw a rental revenue increase of 10% in the first quarter of this year. The company's CEO, Larry Silber, pointed to key growth markets in the country, including semiconductor and data centers, as we've mentioned, renewables and public infrastructure, and expansion of its own specialty product offering. As in Europe, the growth of these new business areas will be a vital part of rental companies' plans going forward. According to Dublin-based consultancy Linesight, the USA, which is already home to the world's largest number of data centers, the pipeline for new projects stands at $160 billion. On the subject of specialty rental, in March this year, United Rentals acquired temporary roadway rental business Yak Access, alongside a couple of others, for $1 billion. Matthew Flannery, the CEO of United Rentals, said, "Our acquisition of Yak provides another excellent example of our strategy to grow our specialty rental business." Ashtead Group, which owns another rental giant in the country, Sunbelt Rentals, said its specialty business could amount to $5 billion in revenues by the end of its current 5-year plan. The growth of USA and Europe's generalist rental companies is a far cry from the rental sector in China, which is yet to move into any significant level of maturity. Having said that, the country's largest rental companies have been growing at a huge rate, but this is with access equipment specifically, while the generalist model has not properly got started. Last year, I explained how the total access fleet size of the Chinese rental companies in the top 25 of Access International's Access 50 listing of the world's largest rental companies stood at 230,000 units. That's compared to 142,000 units in 2022 and 0 in 2017. Overall, the access industry in China has been growing around 40% year on year. Forecast this time last year was that growth would slow over the next couple of years due to the market becoming more saturated. That slowdown has already started, and annual sales of access equipment in the country has now dropped from 40% year on year, closer to 10%. As always, there are one or two exceptions, but this is the general trend. But it's not all down to saturation. The ongoing economic downturn in the country does not help, nor does the construction crisis, with there being around 390 million square meters of unsold residential property in China. That's according to the National Bureau of Statistics. Besides an immature rental sector, the market is ultra competitive, which is having a negative impact on product pricing and rental rates. At the International Rental Conference, which took place in Shanghai last October, Wang Xin, chairman of Shanghai-based rental company CCBF, told delegates that the rental market was suffering from a problem he characterized as too high, too low, too long, and too short. This means aerial platform production rates are too high, utilization rates are too low, payment times are too long, and product life and customer loyalty are too short. He predicted that these problems will lead to 30% of China's rental companies disappearing in the next 3 years, due to, he said, a rat race of self-destructive behaviour. Nevertheless, the future of the access industry in China is strong, despite these wider downturns. Emerging industries such as wind power, solar energy, and wider renewable energy solutions have broad potential for aerial platforms. This is aided by the Chinese government's support of equipment manufacturing and its introduction of policies to develop that. In addition, China's active promotion of the Belt and Road Initiative is set to further promote the domestic mute market and expand it overseas. This philosophy extends to the mute rental sector, in which large Chinese rental companies are now looking to branch out to international markets. This could have a huge effect on emerging access nations in Southeast Asia, the Middle East, and further afield. For example, Paul Rankin, the COO of Loxam's Powered Access Division, is experiencing this firsthand, starting with the Middle East, where the company is active. He said in an interview with Access International, "We're seeing Chinese companies confirming their move into the market now, with Shanghai Horizon Rentals, China's largest rental company, being the first recently to state their intentions." Looking at developments in equipment, sales of electric rough terrain mutes have taken off in China. Of all boom lifts and rough terrain scissors sold in the country, at least 90% are electric, thanks to the expansive charging infrastructure in the country. Electricity is now installed on all construction sites at the beginning of a project. And combined with the increasingly high fossil fuel costs, diesel engine powered units are inefficient to use or transport across the country. With the speedy development of technology in the access sector, China's domestic mute rental market will be forced to become more mature. Shirley Li, managing director of Mantel, one of the first mute specialists to be established in China, told Access International that rental rates have reduced by 20 to 30% in the last 2 years, and it now takes 6 to 7 years for rental companies to make a return on investment. Competition among manufacturers has grown so strong that it cannot last, she said. And Li believes that in the future there will be no more than 5 big OEMs, plus a range of niche aerial lift producers in the Chinese market. Li added, price, quality, and service have become key factors for companies to compete for market share. And on that salient point, I would like to thank you for watching this webinar and wish you all a successful year ahead.
Thank you very much, Euan. That was very insightful and some great information within there. Now I'm going to hand over to Theo to delve into the Italian country report. Over to you, Theo.
Hello everyone, and thank you for joining our webinar. As every year, Dr. Carlisle is preparing the IPAF MEWP rental market report, which looks at the evolution of main market indicators in various regions: Europe, North America, and China. My name is Theo Castel, analyst at Carlisle, and I will present you an extract of one of our country reports. The estimates and market vision presented in the MEWP rental market reports are developed using a methodology consisting in triangulating data coming from in-depth interviews with market players, rental companies, but also MEWP manufacturers and other market experts such as suppliers of manufacturers, association representatives, etc. We also use secondary information related to construction, rental statistics, and other macroeconomic indicators. IPAF has been partnering with Carlisle since 2009. We thus now rely on 15 years of historical MEWP rental market data. And over the years, Carlisle has shown an excellent track record of forecast accuracy. The IPAF MEWP rental market reports offer an in-depth analysis of the MEWP rental markets in Europe, North America, and China. For each region, Carlisle analyzes market revenue and growth trends, fleet sizes and expected evolutions, fleet mix including alternative energy penetration trends. We also examine rental companies' investment fluctuations and observe operational indicators like utilization rates, retention periods, payback periods, and rental rates evolution. These indicators, trends, and forecasts are extremely useful for companies active in the market. Rental companies, of course, but also equipment manufacturers, suppliers, and even investment funds, as they empower these companies to take informed decisions whether investment planning, growth strategy, or business orientation. So today, we will present you an extract of the Italian report with a look back on the year 2023 and forecasts for 2024 and 2025. Before starting, Carlisle and IPAF would like to thank all companies who kindly participated to the project preparation and estimate development. The Italian MEWP rental market grew at a strong level in 2023, in line with last year's forecast. Let's take a closer look at market indicators and how they've evolved in the past couple of years. In 2023, the Italian MEWP rental market continued to grow at a healthy rate. MEWP rental revenue rose by 8%, similar to its 2022 level, and reached almost 336 million euros, an unprecedented level, driven mainly by increase in fleet size and rental rates. The cross-hire level, over 8%, remains one of the highest among the European countries under study. While fleet size increase helped absorb the solid market demand, rental companies were still facing lead time issues. Outlooks are positive but more moderate, with revenue growth rates ranging at around 4% or less for the years to come. Before reviewing fleet size, I would like to remind you that we exclude low-level access equipment from our scope. In 2023, MEWP rental fleet size went close to 34,000 units. The market went back to a more normal pace of investments, with incentives slowing down and inflation affecting materials and equipment. The many machines that were purchased in 2022 as interest rates were low helped renew and expand fleets, slowing down the pace for further purchases for 2023 and 2024. In 2024, fleet is expected to grow further, but at a more moderate pace as post-pandemic government incentives phase out and inflation affects equipment prices. By 2024, the fleet size should get closer to 35,000 units. In 2023, MEWP utilization rate remained stable at 66%. The market demand was strong and the recent fleet size increase allowed to maintain utilization at a satisfactory level for rental companies. The construction end sector is a heavy user of MEWPs, and in parallel, rental companies explore new opportunities in warehousing and logistics and applications. Utilization could increase slightly in 2024 as investments and fleet expansion will be more limited in a context of demand maintained at high level. In 2023, rental rates have increased significantly. A 6% growth rate is reported across the board under the influence of several factors such as rising demand, but also overall price increase driven by both inflationary pressure and increasing MEWP purchase prices. This growth allowed for an improvement of the average revenue per unit close to its pre-pandemic level. As inflationary pressure releases a bit, rental companies do not envision such a significant rental rate growth in the future and expect it to be more moderate. We just took a close look at the Italian market, but I would like to share some general trends regarding the rest of the world. Europe as a whole experienced a 6% revenue increase in 2023, reaching a turnover of 3.4 billion euros. The market growth has been driven by sustained demand, some fleet expansion, and most certainly rental rates growth at a time of heavy inflation. Outlooks for 2023 are moderately optimistic and further moderate rental revenue growth is expected. Manufacturer lead times are expected to further stabilize and rental companies forecast continued healthy demand. However, as inflation is anticipated to ease in Europe, rental rate increases should slow down while an investment decrease is expected as rental firms plan on more cautious spending to target margins over volume. In terms of equipment trends, the market continues to see the penetration of electric engines growing in both scissors and boom fleets. European MEWP fleets show a high level of fleet electrification, the main remaining barriers being linked to a lack of existing technology for some rough terrain or higher heights machined categories. The North American market experienced another year of significant growth in 2023 with double-digit revenue growth rate. China MEWP rental revenue kept increasing at a fast rate, driven by fleet expansion and increased utilization. In 2024 and 2025, the anticipated decline in rental rates and the slowdown in rental fleet expansion are expected to result in a more moderate MEWP rental revenue growth. We hope that this short presentation answered some of the questions you had. More elements will be available in the IPAF MEWP rental reports, which will be released in June. More specifically, you have the option of ordering several report packages: Global Report and all countries, Global Report and one country, individual country report including the North America report. All the information is gathered on the web link shown here. Thank you very much for your attention.
Thank you very much to both Euan and Theo for those great presentations and insights. Hopefully you saw from Theo's update the individual country reports go into quite a bit of detail, and I would hope that you see that if you're in a particular region and you've not had these reports before, they will be of great use to you. As I mentioned before, the reports are available to all IPAF members at our rental companies, manufacturers, dealer distributors and suppliers free of charge this year, and other IPAF members can get individual country reports from as little as €174, £145 or $182. Surely worthwhile for your country if you want some insight to help you forecast, budget and make some financial investment decisions. Thank you once again for watching, and please order your rental reports at ipaf.org/reports. Thank you very much and see you soon.